Hey everyone, welcome back to the channel. So let me throw this at you. How does one of the richest investors ever pick stocks that just keep printing money? Yep, Warren Buffett, the Oracle of Omaha. Now, one of his favorite tools? It's something super simple that you've probably heard of, the price to earnings ratio. Stick with me because by the end of this video, you're going to know how Buffett uses the price to earnings ratio to spot undervalued gold mines. And yeah, why you should too. All right, let's dive in. What even is the price to earnings ratio? It's just the stock's price divided by its earnings per share. So let's say a stock is trading at $100 and its earnings per share is $5. Then the price to earnings ratio is 100 divided by 5 equals 20. Boom. Simple stuff, right? But here's the catch. This little number actually tells a big story. A high price to earnings ratio? That usually means the stock is expensive or people are betting big on future growth. A low price to earnings ratio? That might mean it's undervalued, or maybe there's something fishy going on. And that's where Buffett comes in. So, how does Warren Buffett use the price to earnings ratio? He's not just looking for cheap stocks. Nah, Buffett's all about value. He wants to know, am I paying a fair price for the earnings this company is making? One of his classic quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." That's classic Buffett right there. So when Warren Buffett sees a company with a low price to earnings ratio, he doesn't jump in right away. He pauses and investigates. Is this company just cheap? Or is it a great company that's being undervalued right now? Buffett is always looking for what we call a margin of safety. He wants to buy great companies when they're selling for less than what they're really worth. Let me give you a real-world example to make this crystal clear. Back in 1988, Warren Buffett started buying shares in Coca-Cola. Now, at the time, Coca-Cola wasn't a trendy tech company or a growth rocket, but it had something Buffett loves. A strong brand known around the world, consistent profits year after year, a loyal customer base, and a moat. That's Buffett's word for a competitive advantage. Even though the price to earnings ratio was not dirt cheap, it was reasonable, around 15 to 16 times earnings. That meant investors were paying $15 to $16 for every $1 of Coca-Cola's annual profit. So Buffett looked at Coca-Cola and said, the price seems fair, the earnings are strong, the brand is powerful, and people will probably still be drinking Coke 20 years from now. And he was right. He didn't buy it just because of the low price to earnings ratio. He bought it because the business was rock solid. He used the ratio as a starting point and then did a deep dive into the company's fundamentals. What solid fundamentals means. Let's break that part down too. When we say solid fundamentals, we're talking about things like strong revenue and net income growth, high return on equity, ROE, low debt or good debt management, consistent cash flows, and a management team that makes smart decisions. So Buffett's thinking was, all right, the price to earnings ratio looks okay. Now let me look under the hood. Good earnings, strong balance sheet, powerful brand. Yep, people are sleeping on this stock. Let's go. Now imagine it's today and you're looking at a company like Intel INTC. Let's say Intel's price to earnings ratio is around 15, while its competitors like NVIDIA have price to earnings ratios over 30, 40, or even higher. At first glance, you might say, whoa, Intel is cheap. But then you do your homework. Is Intel still making solid profits? Is it investing in innovation? Does it have a moat or strong customer base? Or is it struggling to compete? If the answers are mostly positive, Buffett would probably say, hey, the market's ignoring this stock, but the fundamentals are sound. Let's grab it before the crowd wakes up. That's exactly what happened with Coca-Cola. Buffett bought it when others weren't paying attention, but the business was strong. But he always asks, is this business worth owning 10 or 20 years? If the answer is yes, and the price looks good, that's a Buffett-style bargain. Now you're probably thinking, all right, cool, but I'm not Warren freaking Buffett. Why should I care about the price to earnings ratio? Well, let me ask you, do you want to stop buying overpriced hype stocks? You want to actually know if something's worth your cash? then yeah, you should be using the price to earnings ratio. But here's the key. Don't just look at the number by itself. You got to compare it to the industry average, the company's past price to earnings numbers, and how fast its earnings are actually growing. A tech company might have a price to earnings ratio of 50, and that could still be okay because people expect it to grow fast and make a lot more money in the future. On the other hand, a regular retail company might have a price to earnings of 25, but if it's not growing much or has problems, that price might actually be too high. So don't just look at the number by itself. Look at the full picture. Do a little research. Understand the company. And if everything looks good, then hey, you might have just found a great stock to invest in for the long run. All right, so what did we learn? Warren Buffett uses the price to earnings ratio not just to find cheap stocks, but to find undervalued, high-quality businesses. He mixes logic, patience, and plain old common sense. And now you've got that same tool in your hands. So go check out some stocks, look up their price to earnings ratios, do some digging, and see if you can start investing like Buffett. If this video helped, smash that like button, hit subscribe, and comment. Now I get why Buffett cares about price to earnings. If you found this video helpful, you'll definitely want to check out my Udemy page where I offer a range of in-depth courses on AI in accounting, finance, and business. These courses are designed to give you practical skills you can apply right away, whether you're a student, a professional, or a business owner looking to stay ahead. With hundreds of enrollments and 5-star reviews, learners from around the world are already seeing results. Click the link in the description to explore the courses and start learning today. Thanks for watching.